RBI should take cognizance of the fact that you cannot control food inflation by keeping money supply tight. So it will be interesting to see that as the new governor comes and delivers the first policy in early February, do they really change their stance on inflation and interest rates? The government stuck to 4.4, showing a fairly handsome fiscal consolidation. And this is important because A, it paves the way for the RBI to loosen monetary policy and cut rates, because higher fiscal deficit means that the government has to borrow more, and if the government has to borrow more, it crowds out private investment and it makes RBI's job difficult to cut interest rates, and especially at a time when the dollar is so strong and the rupee is weakening. And therefore, it was extremely important for the government to show a very tight fiscal discipline, and that's exactly what the government has done. As you all know, we have a new RBI governor, and very clearly, the RBI governor has pivoted from running a very restrictive monetary policy to a relatively more benign monetary policy stance. So we've seen not only a 25 basis point rate cut, we've started to see that the RBI has started to infuse liquidity into the banking system, which was running at a deficit. And on top of that, the latest regulatory policy was to reduce the risk weights for lending to NBFCs and MFIs. Last year, the RBI had significantly disincentivized growth in credit, liquidity was tight, and provisioning norms were also made tighter. What we are seeing is that the new RBI governor is now letting loose some of those very strict provisioning and reserve requirements. Back in 22, India used to import 9% of its oil from the United States. And from 9%, the share of the US fell from 9 to 4%. In fact, last year in 2024, it had almost fallen to 3%. So one of the things that we have done is that if, let's say hypothetically, India was to take its share of imports back to 9%, right? Which means that almost more than double its share of imports from the United States, and assuming that we buy oil at, let's say, $70 per barrel, that would mean that we would have to import almost $7.6 billion more of oil from the United States. And what it means is that at least 25% of that $36 billion surplus that we have can be mitigated by buying more oil and gas from the United States. Now, whether that share is at 9% or India decides to go even beyond 9%, clearly this is one tool that India has apart from defense, where it can buy more oil at the cost. Probably we may have to reduce our oil imports from some of the other countries like Russia or the Middle East and divert that to the US.
It's been a volatile last 4 months with Trump tariffs, with geopolitical risks, FI selling in the first 3 months, and then April FI buying, and the markets going up almost 5%. So here are a lot of fears, there are a lot of uncertainties. People are looking for clues across the board.
Ever since the end of 24, when we started witnessing some slowdown in Indian growth and the geopolitical tensions rising and the fear of tariff wars coming through, there was some profit booking in this trade, wherein there was revival of the financials and there was some profit taking in the industrials. Within financials also, we've witnessed one more interesting trend, that instead of the lenders leading the way, it was the other financial services like capital markets leading the way. So while that 5-year kind of gain of industrials versus the financials is kind of broken for the short term, but this could be a short-term blip in an otherwise longer structural story, given the fact that India is resolved to increase the share of manufacturing in the contribution to the GDP. So we do think that there's longer role of cyclicals and industrials to be seen. Let's wait for another 1 or 2 quarters for numbers to unfold so that we become far more clearer as to whether this short-term trend is the one that will be lasting or we go back to industrials leading the way.
While large caps and the Nifty might look cheap, but frankly on an aggregate basis there is very little earnings growth. And while mid caps may look expensive, the earnings growth is very robust at 28% in quarter 4. And therefore, we believe that even if you look at the rebound from the lows that we saw in March and April, immediately after the tariff announcements on April 2, you will see that the small and the mid caps have actually bounced back much faster than the large caps. In other words, it has taken us, as they say in Ramayana, there was a 14 saal ka vanvas, right? After 14 years, we are seeing that the private sector Capex is now coming back to the levels that we saw in 2010-11. And therefore, we believe that India's Capex story is back. And this time, while it was initially helped and started by the central government Capex, we are now starting to see the early signs of a breakout in private Capex as well. However, we do believe that with a good monsoon, with the tax cuts, and the kind of liquidity that the RBI has infused in the economy, we do believe that consumption should also revive over the next few quarters. But we still believe that the strong leadership in this market will continue, like we've seen, especially post 2022, will continue to be driven by manufacturing, cap goods, and largely the sectors which are related to the investment cycle. While India was one of the earliest countries to have started negotiation on a bilateral trade agreement with the United States, there are clearly some disagreements, and India has not yet been able to sign a definitive agreement or arrive at even an interim trade agreement with the United States. And as a result, President Trump decided to levy a 25% tariff on Indian imports into the US. And this time, if you look at the pecking order, relatively, as per the latest tariffs across countries, India isn't as favorably placed as it was when tariffs were first announced during Liberation Day in April. This GST has delivered on roti, kapda, motor gadi, and makan. The breadth of reduction and rationalization almost touches every aspect of the consumer's life. The household savings as a result of reduction of taxes will be almost to the extent of 48,000 crores annually. So friends, it's not just about the one-time savings of 48,000 crores. There is a concept of economics which is called the multiplier effect. Savings leads to higher consumption leads to higher production in turn leads to higher incomes, and that higher incomes again leads to higher consumption. So there is a virtuous cycle which is set in place. And various economists have predicted that the multiplier effect of this could be anywhere in the range of 1.8 to 2 times. We believe that as per one estimate, the net benefit to the economy could be as high as 87,000 crores. If we were to really look at which are the sectors which will really benefit from the rationalization and reduction of GST rates, I think the number one sector is automotives. Just the 4 top hyperscalers from the US, which is Meta, Alphabet, Microsoft, and Amazon, have significantly ramped up their investments in AI. From a $94 billion investment in 2020, this number has reached a staggering $325 billion in 2025. With artificial intelligence is basically the first level of value creation would happen, because the most value will be created in extraction and interpretation of data. And therefore, companies that build Gen AI or large language models, build data centers, the hyperscalers that we talked about, are at the forefront of initial value creation. Once the data centers have been built and the GPU capacity is up and running, this GPU service opportunity itself is likely to be a multi-billion dollar opportunity. For example, the current GPU service opportunity is close to $1.4 billion. That itself, by several estimates, is likely to reach almost $6 billion by 2030. In fact, we believe that so significant is the demand for power that many of these Indian companies are not only servicing the booming India demand, but are also exporting to several countries, including the United States. Many multinationals are using India as a manufacturing base for transformers and critical power equipment to be exported to their foreign parents as well. In the latest September 25, for which roughly more than 80% of the results are out, we are at a 5-quarter high of 16.6%. And that gives us significant confidence that the bedrock of the equity markets, which is earnings, has started to revive. And therefore, there is a very high possibility that by the time we close this earnings season, we will see the end of downgrades and the beginning of stability and upgrades and growth coming back. In the immediate current context, what we are seeing is a divergence. And what I mean by divergence is that while the breadth of earnings has improved, the breadth of stock market performance has actually worsened. And what I mean by that is that a very narrow section of stocks is performing while the breadth of the market continues to struggle. I think one trend that comes out very clearly is that banking and financial services is certainly coming out tops at this point in time. It could also be because it has the largest weight in the index, and as I explained, that currently we are seeing that a lot of money is hugging the benchmark, and the benchmark performance and the market performance is actually very, very narrow.